Investing has somehow become one of the most overcomplicated topics in personal finance. You open social media and people are talking about day trading, stock picks, complex investing strategies. And meanwhile, you're just sitting there wondering, should I invest in my bank, use a robo advisor, or try to do this myself? And honestly, that confusion stops a lot of people from investing at all. Because once you finally get your budget together, once you finally build the emergency fund, once you start thinking about your TFSA, your FHSA, or your retirement, now the pressure shifts. You don't want to mess it up. You don't want to feel behind, and you definitely don't want to choose the wrong option. If you're new here, I'm Brianne, I'm a CPA, and I talk personal finances in a way that actually makes sense and in a way that actually can fit your real life. So today we're walking through the 3 main ways that people invest. We'll talk about what each one actually means, how the fees work, and how to decide which one would actually work best for you. Because the best investing strategy isn't usually the most complicated one, it's the one you'll actually stick to. So let's simplify this. There are basically 3 ways that people invest. And the biggest difference between all of them is really just who's making the investment decisions. The first option is investing through your bank. This is the more traditional route. You walk into your bank, you speak to an advisor, you tell them you want to start investing, and they'll usually recommend a mutual fund. So what is a mutual fund? The easiest way to think about it is that it's a basket of investments. Instead of buying individual stocks yourself, your money gets pooled together with thousands of other investors. Now, one thing I want to clarify here is that you're not completely hands-off in this decision. Your advisor will typically ask you questions about your risk tolerance. So whether you want something more conservative, more balanced, or more aggressive. And this is what determines what type of fund you're placed into. So you still have input, you're just not the one choosing the individual investments inside the fund. So inside that mutual fund, you might have things like Apple, Microsoft, Canadian banks, energy companies, or hundreds of other businesses. That fund manager then adjusts the investments over time, which is why this is typically called managed investing. And this ties back to something really important: risk tolerance. Some people are more risk averse. They don't like seeing big drops, they prefer stability. Others are more risk neutral, so they're okay with some ups and downs. And some people are more risk tolerant. They're comfortable taking on higher risk for more growth. Now, the trade-off here is the fees. Many bank mutual funds typically charge around 2% annually, or sometimes even a little bit more. And that might not sound like a big deal, but over 20 to 30 years, those fees can add up significantly and reduce your growth. That doesn't automatically make it bad though. What you're paying for is guidance and someone to manage your investments for you. And for a lot of people, when they're just starting out, that support is what can help them stay consistent. The second option is something called robo advisors. This is kind of the middle ground. Instead of sitting down with an advisor, you answer a few questions online about things like your age, your goals, and how comfortable you are with market ups and downs. So again, risk tolerance still plays a role here. Then the platform builds an investment portfolio for you. For example, if you use Wealthsimple Invest, they'll automatically build a diversified portfolio, typically using ETFs. Those ETFs might represent the US stock market, Canadian markets, international stocks, or bonds. The platform automatically manages the portfolio. It handles rebalancing and keeps everything aligned with your risk level. The fees are also usually much lower than traditional mutual funds. So you're still getting structure and management, but it's done automatically. And for a lot of people, this ends up being a really comfortable option because it's simple and hands-off. The third option is self-directed investing, or DIY investing. This is where you open a brokerage account through a platform like Wealthsimple Trade or Questrade, and you choose your investments. Now, when people hear DIY investing, they sometimes imagine constantly researching companies to try to pick a winning stock, but it actually doesn't have to be that complicated. And this is where a lot of people unfortunately get intimidated. DIY investing doesn't mean you need to become a stock market expert. For a lot of people, it can be as simple as choosing 1 or 2 broad ETFs and investing consistently over time. An ETF is also basically a basket of investments, similar to a mutual fund. But instead of a manager choosing the investments, many ETFs simply track something called an index. So what's an index? An index is basically a list of companies that represent a market. For example, the S&P 500 is made up of 500 of the largest companies in the United States. When an ETF tracks the S&P 500, it simply is buying shares in those same companies. So instead of trying to pick the next winning stock, you're investing in the entire market. And that's where diversification comes in. You're not relying on one company, you're spreading your investments across hundreds of different companies, industries, and sometimes even countries. So your money isn't reacting to just one thing. Another advantage is the fees. Typically, ETF fees can range from 0.05% to 0.2%, which is dramatically lower than mutual funds. So more of your money stays invested and grows over time. And really, when you step back and look at these 3 options, you're essentially choosing between 3 things: paying someone to manage your investments, using technology to manage them, or managing them yourself. That's really the difference. A lot of investing conversations focus on fees, and fees do matter, but behavior matters more. Because the biggest risks to your investment isn't usually picking the wrong ETF, it's quitting. And most people don't quit when things are going well, they quit when the market drops. They panic, they pull their money out, and they lock in the loss. And then they also miss the recovery. And for some people, trying to manage everything themselves actually makes that worse. They check their portfolio too often. They stress, they react emotionally. So sometimes choosing a more hands-off option, even though it may be a little bit more costly, is what actually helps you stay consistent. So how do you decide which option is best for you? You have to ask yourself a few honest questions. Do I enjoy learning about investing? Will I manage this consistently? How do I react to market drops? And am I optimizing or building something sustainable? If you're still building financial confidence, a Robo advisor might be the perfect starting point. If you're comfortable learning and staying disciplined, then DIY investing might work better for you. If you want more guidance and structure, then a mutual fund might be the better option. A lot of people already feel behind when it comes to investing. And when people already feel behind, they either rush or they freeze. But investing honestly isn't about catching up overnight. It's just about starting and staying consistent. The difference between someone who builds wealth through investments and someone who doesn't usually isn't intelligence. It's time in the market and it's emotional control. So if you've been overthinking the decision, let me give you the permission to choose the option that works best for you right now. You can always evolve your strategy later. When I first started investing, I used a mutual fund through my bank. But as I learned more, I eventually transitioned into DIY investing using ETFs. Investing isn't a personality test, it's a system. Start simple, stay consistent, and adjust as you grow. If this video helped you understand your options a bit better, make sure you like and subscribe. And I'm curious, how are you currently investing? Let me know in the comments. And as always, I'll see you in the next video.